Hello friends, DK this side. Today we are going to talk about passive investment versus active investment. These are the two different styles of investment, especially in the stock market. So we'll be talking this particular important issue in context of stock market. This topic, passive investment versus active investment, has been in a debate for several years and will continue to be in debate for many more years to come. However, while comparing the two, it is very important to realize that you can make money even as a passive investor. However, there are different kinds of advantages and disadvantages in both kinds of style of investing. So as a beginner, you need not always have to actively looking for an investment tips or ideas in the stock market. There are decent returns which can be made by remaining a passive investor. And if you are an absolute beginner in the field of investment and you are confused whether you should become a passive investor or active investor, probably this tutorial video is for you. So watch this video till end so that you have a fair idea about these two different kind of strategies or investment styles, and then you understand the advantages and disadvantages of these two different kind of styles in the stock market for making an investment. Friends, do not forget to like the video. To begin with, let us understand what is passive investing in stock market. Various stock market exchanges world over, they have designed index to include various stocks as a part of that index. For example, S&P 500 or Dow Jones Industrial Average Index or Nasdaq 100 in the US stock market, or Nifty 50, Sensex, Nifty 100, Bank Nifty in Indian stock market. These are the broader index in the stock market. There can be an index relating to a particular sector. For example, Bank Nifty is a sectoral index representing the banking sector in India. Similarly, you have a IT sector index called Nifty IT. Or Nasdaq 100 in USA represents the tech stock or technology stocks in US stock market. So these indices broadly represent the chunk of the broader stock market, which comprises of diversified stocks if not selected as a sectoral index. For example, Nifty 50 has a stock that come from various sectors of economy. And so is the fact for S&P 500 or Dow Jones Industrial Average Index. So index itself is a diversified kind of portfolio which are regularly rebalanced so that bad performing stocks are always out of the index and new stocks which is performing well is included in the index. So a passive investor, if he chooses to invest in a particular index, he need not to bother about a stock selection in the stock market or do a research work to select a particular stock which belong to a fundamentally sound business, or do a technical research on the price chart of particular stock. Typically, in these kind of index like Nifty 50 or S&P 500 or Dow Jones Industrial Average Index, typically in these kind of index constitution, large companies have a higher weightage in these indices. So passive investing doesn't require a great deal of skill, knowledge in choosing a particular stock in the market. Now, in order to indulge in passive kind of investing in index, one can go via mutual fund route. There are good numbers of index mutual fund available in the market, or one can choose to invest in ETFs, that is exchange traded fund, which are traded on the exchanges itself. If I summarize passive investing in a simple language, what does it mean? It means the moment you have bought an index fund or bought an ETF of a particular index like Nifty 50 or Dow Jones Industrial Average Index or Sensex, what you have done, you have created a diversified portfolio and your investment is exposed to the top performing company of the country. Historically, if you see the price chart of any index like S&P 500 or Nifty 50 or Sensex, the secular trend in that index has always been bullish. Look at the average returns historically from Sensex or Nifty 50. It has been around 14 to 15%. So if you are getting a return of 14 to 15% without doing any research work, just simply being a passive investor, what does it mean? Your investment is beating the inflation and your investment is growing. Now let us understand what is active investing. Instead of choosing an index or index fund or ETF or index, investors who are active investors, they create their own portfolio with a set of stocks from different sectors of economy. When they construct a portfolio for themselves, those stocks may not be from index or might be from index, but they do their own research work to find a suitable company which are fundamentally sound in terms of business and create their own portfolio with the sole aim of outperforming the index to generate better returns. And this is called active investing in the stock. There are majority of people in the stock market who are participating in the stock market. So they are well aware also that index investing or passive investing can give them consistent returns over the period of time. But sometimes investing in the index or being a passive investor is a boring profession. So they want to engage themselves into the stock market by feeling proud of choosing the stock from the stock market based on their own research, which might perform or may not perform. But ultimately, active investing is all about choosing a stock from a fundamentally sound business, doing a technical research, and then create a portfolio that has a probability to outperform the index. An active investor who creates their own set of stocks and construct a portfolio, they gauge their performance by comparing the performance of their portfolio with the index, because their sole aim is to outperform the index. So for example, an index in last 1 year has given a return of say 15%. And if their portfolio has given a return of 20%, so they have outperformed the index by 5% in last 1 year time. This is called alpha of their portfolio. If alpha is 5, means they have outperformed the index by 5%. If alpha is 7, they have outperformed the index by 7%. Or if alpha is -3, they have underperformed the index by 3%. If we create a portfolio of our own by doing our own research work, and our portfolio is not outperforming the index, what is then the fun to create own portfolio when you can easily get the returns of say 15% by investing in the index fund or by investing in the index ETF? Now I would like to give a piece of advice to those who are beginners in the stock market and just stepping their foot in the investment world. That if you want to become an active investor, then you should learn reading the financial statements, doing the fundamental analysis, so that you can find out a suitable stock from the ocean of stock market where 7,000, 8,000 stocks are being traded, and have a sound knowledge of technical analysis so that you can decide when to buy a stock and when to sell a stock from the price action in the market. Let me clarify, friends. I am not advocating to be an active investor or a passive investor. You have to judge yourself based on your own strength to be a passive investor or an active investor. But we must know the advantages and disadvantages of being passive investor or active investor. To begin with, let us talk about the advantages of active investors. An active investor has a flexibility to choose any stock being traded in the stock, because he understands the stock. If that particular stock, based on the fundamental analysis, is found to be undervalued from a sound business that company operates, and then look the chart formation, and if there is a trend reversal in that particular stock, can choose that stock for his or her portfolio. So the flexibility is the cornerstone of active investor. Then the possibility of getting a better returns than index is very, very high, provided an investor has a skill to do the fundamental research and technical research of a particular stock. What are the disadvantages of being an active investor? Number one, it is expensive, because you have to do a multiple transactions, which is not required to do if you are a passive investor in index fund, or for that matter in index ETF. Another disadvantage is higher risk involvement being an active investor, because we do n number of research, fundamental and technical, and despite the stock may not perform the way we wanted it to perform. Now let us understand the advantages and disadvantages of passive investing. Number one, it has a low transactional cost. Whether you invest through a mutual fund route in index fund or do investing with exchange traded fund of a particular index, the cost involved is much less, because you are not required to do multiple transactions. The another advantage is transparency, because passive investing is more transparent than active investing, because it involves only the index stocks. Everything is clear and very simple. What are the disadvantages? The disadvantages is you don't have the flexibility. Even if the index is not performing, even at that point of time, you might have a stock in the market which are fundamentally sound and technically good to choose from and outperform the market or index even in the bear market phase. So the scope is very much limited as a passive investor. And in passive investing, there's no chance of getting a higher alpha. You simply cannot outperform the index because you have invested in index. So friends, I hope this is small tutorial on passive investing versus active investing might have given you some kind of insights being an active investor or a passive investor. Give a lot of thumbs up to this video, share this video, subscribe the channel, hit the notification bell for updates. Looking forward to meet you very, very soon.